Equipment finance brokers don't lend the money. So what do? A $2,000 monthly equipment payment may sound affordable, but what if the real cost includes application fees, documentation charges, insurance requirements, taxes, maintenance, an expensive buyout, and penalties for paying the balance off early? That is why equipment finance brokers cannot explain a deal using the monthly payment alone. In this video, I'll break down 7 costs that brokers should help clients understand before they sign an equipment lease or financing agreement. When people hear hidden costs, they often assume someone is trying to hide something illegally. That is not always the case. Many costs are disclosed somewhere in the agreement. The problem is that business owners may focus on the payment and overlook the total financial commitment. As a broker, your job is not to promise approval or tell the client that one structure is always best. Your job is to help the client understand the offer, identify the important questions, and compare the deal with the equipment's expected business value. Let's walk through the 7 areas that deserve attention. The first cost is the most important: the total amount the client will pay over the full term. A monthly payment can look attractive when viewed by itself. For example, imagine a client finances equipment with a payment of $2,000 per month for 36 months. That equals $72,000 in scheduled payments. But the client also needs to know whether there is a down payment, a final balloon payment, a purchase option, or additional fees added to the agreement. The structure may involve an interest rate, a factor rate, a lease payment calculation, or another pricing method. These structures are not always directly comparable. So instead of asking only, "What is the monthly payment?" the client should ask, "What will I pay in total if I make every scheduled payment?" And if there is a purchase option at the end, what will it cost to own the equipment after the final payment? A lower monthly payment can sometimes mean a longer term and a higher total cost. The second area is upfront fees. Depending on the lender and transaction, a client may encounter application fees, origination fees, documentation fees, filing fees, wire fees, or other administrative charges. Some fees may be paid at closing. Others may be included in the amount financed, which means the client may also pay financing costs on those fees. That is why brokers should request a clear breakdown before presenting the offer as approved or ready to close. A simple question is, which charges are paid up front and which charges are being added to the balance? The client should also ask whether any broker compensation, lender fee, or third-party cost is included in the transaction. The exact fees vary by lender and business model, so never assume that one lender's process applies to every deal. The third area is soft costs. The equipment price may not include delivery, installation, setup, customization, software, training, or required accessories. For some businesses, these costs are minor. For others, they can significantly increase the amount needed to put the equipment into service. A machine sitting in a warehouse is not producing revenue. So before the client signs, the broker should ask, what does the equipment need before it can begin working? That might include shipping, electrical work, construction, installation, licensing, calibration, or employee training. These expenses may or may not be financeable, depending on the lender and the transaction. The key point is simple. The client should budget for the equipment being operational, not just delivered. The fourth area includes ongoing ownership and operating costs. Financing the equipment does not eliminate the cost of insuring it, maintaining it, repairing it, registering it, or paying applicable taxes. Some lenders may require specific insurance coverage or documentation throughout the agreement. Certain types of equipment may also require maintenance contracts, inspections, service plans, or manufacturer support. These requirements may be reasonable, but the client needs to understand them before signing. Ask, what costs will continue after closing, and which of them are required by the lender? This is especially important for vehicles, construction equipment, manufacturing machinery, and equipment that is expensive to repair or difficult to replace. A financing offer should be evaluated alongside the equipment's expected operating costs. The fifth area is what happens at the end of the agreement. Some contracts allow the client to purchase the equipment for a fixed amount. Others may include a fair market value purchase option, a residual value, a balloon payment, or a requirement to return the equipment. The client should know the end-of-term options before agreeing to the beginning-of-term payment. A low payment may partly reflect a large amount due at the end. There may also be automatic renewal language. For example, if the client does not give notice within a specific period, the agreement may continue or renew under certain terms. That does not automatically mean the contract is unfair. It does mean the deadline and process need to be clear. As a broker, do not summarize the agreement with "you'll own it after the last payment," unless the contract clearly says that. Instead, explain the actual end-of-term options and direct the client to review the agreement carefully. The sixth area is what happens when the client wants to change the payment plan. A business may grow faster than expected and want to pay off the balance early. Or it may experience a slow season and need temporary relief. The agreement may address prepayment, early payoff, late charges, returned payments, default, or repossession. The client should ask, "Can this agreement be paid off early? And how will the payoff amount be calculated?" The answer depends on the contract. Some structures may not reduce the cost as much as the client expects when paid early. Other agreements may include specific payoff calculations or charges. This is not something a broker should guess about. If the language is unclear, the client should ask the lender or a qualified professional for an explanation before signing. The seventh area is broker compensation and disclosure. Equipment finance brokers may be compensated in different ways depending on the transaction and business model. The important principle is transparency. Clients should understand who is involved in arranging the financing, how the broker is compensated when disclosure is required, and whether the compensation affects the structure or pricing of the transaction. The exact requirements can vary by state, lender, product, and business model. That means brokers should maintain clear procedures for disclosures and compliance. Never present a financing offer as completely neutral if there is a compensation relationship that should be disclosed. Trust is not built by hiding the details. Trust is built by explaining the transaction clearly and helping the client make an informed decision. Here is a simple comparison process. Take offer A and offer B and place these items side by side. The amount financed, the monthly payment, the number of payments, upfront fees, total scheduled payments, the final purchase option, insurance and maintenance requirements, early payoff terms, late payment provisions, and any renewal or balloon payment language. Now ask a better question than, which payment is lower? Ask, which offer gives this business the best balance of total cost, cash flow, flexibility, and risk? A business with seasonal revenue may value payment flexibility. A growing contractor may value preserving working capital. A company buying specialized equipment may care more about end-of-term ownership. There is no universal best structure for every client. The right comparison depends on the client's cash flow, goals, equipment, and ability to manage the agreement. Before the client signs, walk through this checklist. First, confirm that the client knows the total scheduled repayment. Second, identify every upfront and recurring fee. Third, confirm what is included in the equipment price and what must be paid separately. Fourth, explain the end-of-term options in plain language. Fifth, review insurance, maintenance, and other ongoing obligations. Sixth, ask how early payoff is handled. Seventh, confirm that all required disclosures have been completed. And finally, encourage the client to read the final agreement and ask questions before signing. Your value as a broker is not just finding a lender. Your value is helping the client understand the transaction well enough to move forward responsibly. One important warning. This video is for general educational purposes. It does not replace legal, tax, accounting, or financial advice. Requirements can vary based on your state, your business model, the lender, and the type of financing involved. Do not guarantee approval, savings, income, or business results. Use written disclosures and follow the rules that apply to your specific brokerage. Before a client signs an equipment lease or financing agreement, do not stop at the monthly payment. Review the total repayment, upfront fees, soft costs, ongoing obligations, end-of-term terms, early payoff provisions, and broker compensation disclosures. A clear explanation can help the client avoid surprises, and it can help you build a stronger, more trusted brokerage. If you are building an equipment finance brokerage, subscribe to Equipment Finance Academy for practical training on finding clients, working with lenders, and improving your deal process. What is the one cost you think brokers explain too late in the financing process?